Folks, this is huge. Tom Lee, who has been pretty much spot on the market for the past few years, just released a new prediction for the S&P 500, and it's a doozy. It came out about an hour ago on CNBC. You're going to get it right here. I'll give you the bottom line first. I'm not about to hold you hostage. I'm not about to waste your time. So don't click nothing, don't smash nothing, don't buy nothing, just listen. So Tom Lee, as I'll show you in a second in the highlights clip, just came out with a prediction that the S&P 500 is going from 6,800 to 7,500 by the end of this year. That is almost another 10% from here, which is the equivalent of what the S&P does in a whole year. I'm going to play you the clip right now, at least the highlights, and then we're going to talk about what this means for the market, what this means for your portfolio, and how we're setting up for this for the next couple of months. Let's hit it.
I think the market has a lot of walls of worry because we've got the shutdown, we've got China, we got the Fed speak, but the market's been up 6 months in a row now. Only 6 times since 1928 that's happened. So if you look at November, we're up 5 or 6 times. And in 1942, it was flat. So basically, November should be really strong. I think at least 200 points on the S&P. But maybe we wobble the first couple weeks just to digest all the gains.
Yeah, that's what I saw in your notes. So initially, there could be some choppy trading at this point. What's driving everything? There's still, I guess, sentiment is not positive, is it? You mentioned the wall of worry.
Yeah, I mean, if you look at it, like AAII, the average sentiment this year is still minus 11.5, like net solidly bearish. That's only happened 3 other times in 35 years, all in the middle of bear markets. So investors feel like it's a bear market, but we're up 17%, which kind of tells me I think there's a big performance chase into year end. You know, over 80% of fund managers are missing their benchmark this year. I mean, I think there is something the market's trying to figure out, which is AI is consuming jobs, but that's turning it into profits for corporates. So like profits are expanding. And then we have profit margins have actually been going up in the middle of tariffs. So how are companies able to take 70% of the tariff hit, but margins are going up? So there must be a productivity boom somewhere. And then we have, like you said, $7 trillion of cash on the sidelines, but we have high rates. And so the Fed, I kind of think, is trying to not overheat the economy. But we know that you just point out, like, housing's in big trouble. So I would say it makes sense if inflation's in a good place and jobs aren't really strengthening for cuts to happen, and that would be really dovish. So I think that sort of comes together before the end of the year.
So you figure no problem with 7,000 by the end of the year, more likely something even above that in your view? Like what, like 7,300?
Yeah, I mean, maybe 7,300, 7,500.
7,500.
Yeah, so we still, in December, we would build on those November gains.
So as you just heard, Tom Lee just said that he thinks the market goes to 7,500. He also said that it might be choppy. He didn't say it's going to happen in a straight line. In fact, he said he predicts a little bit of a slump and then a crazy rally towards the end of the year. He also said that he admits that he's not certain that that's going to happen. Of course, there is no guarantees in this business, and Tom Lee isn't trying to pretend like he has a 100% certainty that this is going to happen. He did have a very high hit rate on stocks for the past few years, but he had bad calls like everybody else. So don't think because Tom Lee said it's going to happen, it's certain, and you're going mortgage your house to jump into the market right now, assuming another 10% from here. Now, the market, according to Tom Lee, it's extremely worried about the fact that we are in a euphoria, about the fact that everything is overvalued, stocks are exploding. So there is a lot of tension from professional investors, from experienced investors who are worried that this is just too much. On top of that, you have the government shutdown that is causing a lot of concern. You have the negativity that came out from Powell. He was a little bit hawkish. And you have the China stuff going on. And Tom Lee is basically saying that the combination of all of these is preventing from people jumping head on into this pool. They're still a little bit apprehensive. And that's a huge catalyst because at some point, he says they'll have to admit we have to get in on this before it's too late. There's just too much money on the floor. Now, of course, he said it's not going to be a straight line to 3,500. Don't think it is. The market never does that. And I agree. Volatility is fine. It is a feature, not a bug. I just think that the truth is somewhere in between. He thinks that the sentiment right now is negative. about the market. I think that it is not euphoric, but it's certainly not negative. I think it's somewhere in between. However, I do think that he's 100% on point with this next argument. Tom Lee is saying that we're going to have a big performance chase towards the end of the year. And what I think that people don't understand is that professional investors, even though they're way, way, way more compensated than normal jobs, they're working under a huge amount of scrutiny. If you're managing rich people's money, you are getting judged against the benchmark, which means usually against the S&P 500 or the NASDAQ. If you're getting paid 2% of AUM, assets under management, and another 20% of performance, the client expects you, at the very least, to not underperform against the market. Because at this point, the rich people are basically saying, what am I paying you for? By the end of the year, it's going to be judgment day for all these well-compensated money managers. And their bosses are going to ask, well, did you beat the S&P or not? For them to stay out, it's a game of chicken. What happens first? They're betting on the market correcting. But the longer this continues, the game of chicken works towards the market. And at some point, what Tom Lee is suggesting is that these folks, at least partially, will have no choice other to jump into the market, pushing prices higher towards that 7,500 spike. Now, I'm not arguing against that. In fact, the logic here makes perfect sense. Of course, the professional money managers are judged against the benchmark. And if you keep underperforming, you will lose clients, you will lose jobs 100%. But what I am concerned about is that retail investors might get the wrong message from what Tom Lee is saying. I think that a lot of investors will look at what Tom Lee is saying as some sort of a guarantee, and they're going to say, well, we don't need logic, we don't need analysis. Tom Lee said it's going to be 7,500. Let's just mortgage the house and jump in. I think that the problem is that most retail investors have not been in the market long enough to understand that the average works like a magnet. It has a gravitational pull, and eventually this magnet, this gravitational pull, is going to take effect and the market will correct. And no matter how good you've been performing in the bull market, it's going to be very painful if you are not set up correctly when the inevitable happens. Because every time I show people this chart, they get shocked. Oh my God, this can't be true, but it is. Over the past 100 years, the market has been doing this without exception. This keeps happening. Now, the price point keeps going up, so it doesn't happen in a straight line, but nevertheless, a lot of people get burned because they buy at the top and sell at the bottom. So now in this market, they're excited and they're thinking about the 7,500 and then 8,500 and then 9,000. And they forget the part that at some point, the market has to come down. What comes up has to come down. But nobody's talking about that right now. Everybody's talking about the opportunity. Nobody's talking about the risk. Now, the time to get excited was 3 years ago when we talked about NVIDIA in 2022, when we talked about Palantir in 2022, when everybody were panicking. This was the perfect time to get excited. Remember the old Warren Buffett saying, I get excited when everybody's bearish, and I get bearish when everybody's excited. Now, this means that right now, by this logic, Tom, we have to get out of the market, right? We have to wait for the market to finally correct this insanity, and then we can jump back in. That's what you're saying, Tom. No, that is not what I'm saying. There is no way to wait for a correction. You're going to be trying to time a top in the market. Timing the top in the market is not only difficult, it is quite literally impossible. You're not going to be able to make money in the stock market if you keep trying to guess where the top is. In fact, the world's greatest experts have not been able to do that. Back in 1996, Alan Greenspan, who was Jerome Powell before Jerome Powell, he had his job, came out and said, hey, this is the top. The S&P was at 750. By the time the market actually crashed, it went up all the way to 1,500. It doubled. There is no way to know when the insanity is going to stop. The market can't stay irrational a lot longer than any of you, myself included, can't stay solvent. Now, you have to understand that even though I just showed you that it's not all blue sky and Tom Lee's prediction, even though the logic is sound, doesn't mean that this is going to continue for the next 10 years for sure, and there's no point in being concerned or worried. In fact, I showed you the opposite. I cast a little bit of doubt and a little bit of uncertainty to get you guys to start thinking the right way. But the fact of the matter is, Tom Lee is going to be right, because at the end of the day, the bull runs last a lot longer than the corrections. On average, we're talking about a 5-year bull run, and on average, we're talking about a 10-year bear market in the US stock market. Now, right now, we're about 3 years into this bull run, which means that statistically, there's at least 2 years until we hit average. We're 87% up on the S&P 500, which means we're not even at 180, which is the average. So historically, we're not in an unusual spot right now. But that doesn't mean we can't get a correction tomorrow, because averages are just averages. They don't have any impact on what happens tomorrow. And a crash or a correction can happen at any moment, just like a huge bull run can happen at any moment. So these averages are just there for you to start thinking the right way, but they're not really going to help you to make a decision. What is going to help you make a decision is this. If you know that 54% of days are positive in the market, and you know that 75% of years are positive in the stock market, and you know that 90% of decades in the stock market are positive, and you know that we've never had a losing 20-year period in the stock market ever, you know what the right play is. And you can say all you want about the market being crazy and irrational, but it doesn't matter. It could take literally weeks or months for the market to correct to the right place. It doesn't matter. Your logic doesn't mean diddly squat for Mr. Market. Yeah, we had a 12-year bull run from 1987 to 2000. That's like a 580% increase. You don't know how crazy the market can get, and trying to predict it is just silly. Now, right now, there's a lot of claims about the market being in a state of a bubble. People are afraid that a bubble is coming and the market may implode. Now, mostly these conversations are based on emotions and guesses and feelings, things that have no place in investing. I've actually analyzed, and I came up with 8 components of a market bubble. Throughout history, we had a lot of market bubbles, and every time they had 8 signals, right? They're all on the screen right now. The red ones point out to the elements we have right now. We have extremely high valuations. We certainly have a quick stock price increase. We have lack of breadth. It's all in tech. It's all in AI. We have low quality companies running up like crazy. And we have a lot of claims about how the old metrics no longer matter in 2025. On the other hand, we don't have a crazy initial public offering market right now. Companies aren't just going public left and right. We don't have an increase in the credit supply in a way that's impactful. And as far as the euphoric sentiment, we have it in pockets. We have it with retail, not so much with pros. We still don't have a mass kind of systemic euphoria going on in the market. So out of the 8, we have about right now 5, which means it's risky, but it's certainly not a foregone conclusion. And that should concern you. But on the other hand, I can show you this chart, and it will be also 100% true. If you've missed the top 10 days in the stock market of the past 20 years, you've slashed your return by 50%. So there is no point really to try and time the top. Tom Lee might be right, he might be wrong, but it doesn't matter, because for the long-term investor, we know that bull markets last longer, bear markets are shorter, and long-term, you can't afford to be on the sideline. And no, there is no way to guarantee you're going to miss the worst 10 days, even though on paper it may look insane. There is, however, a way to make sure you never miss out on the best 10 days, and that is by staying invested. So there is a way to invest in a crazy, insane, irrational stock market. Whatever you want to label this market, go right ahead. It doesn't matter. The market cannot be irrational. The market cannot be crazy. The market is what it is. The only thing you can know is have a system. The only thing you can do is have a process. And this is exactly what I have on the screen right now. If you understand that you have to be invested at all times, if you understand that the market is going to do crazy things, you can put a system in place to make sure you never get screwed. By this system, essentially, as you can see here on the screen, all you do is you pick great stocks, you pick a broad market index, and you keep dollar cost averaging, buying at all times nonstop. Now you increase When the price drops by a certain threshold, here in this example, it's 20%, but you can set your threshold at 10%. It's a personal decision. But once the stock or the broad market index drops, you start buying at a faster pace. Once the price increase, you start buying at a slower pace. You're creating a weighted average and bringing down your cost basis almost to the bottom without timing the market every once. And you're making sure you're going to have money to when the inevitable correction actually happens without timing the market even once. This is a cheat code to get rich slow off the stock market. There is no way to get rich quick. That's gambling. If you want to get rich slow from the stock market, if you're going to do it over the course of the next few years, if you're going to learn how to become a better investor long term, I invite you to join the Academy, patreon.com/TomNash. We're now past 25,000 members. Now, I just want to warn you, it's not for everyone. It may not be for you, and you won't know until you try. That is why we have a 30-day money-back guarantee. You can try it out for 30 days. If you're not happy with it, if it's not for you, that's fine. We'll give you a refund. No problem at all. Try it out. We have limited spots left. Would love to see you there. I'll see you next one.